Hi everyone, I'm in Fire Island, on Fire Island, offshore Long Island. Famous for no cars, bicycles, little trolleys, beaches, very seasonal. We came right after Labor Day and it's pretty dead. They tell me the only year-round population here is just 10%. I don't know 10% of what, quite frankly, but not many people in February, and by all accounts, it's pretty dismal in February, but for many people it's an absolute idyll during summer, and you can see why. You see there's no cars, and somebody is having a great holiday because it's no cars and beaches. And yeah, it's quiet. So on oil, everyone's obviously talking about OPEC and the latest decision. Which we don't tend to worry too much about, or at least the whole quota thing is just a complete waste of time as far as I'm concerned. It's got so, confused and everything else that it's all about really the actual physical incremental barrels that are coming onto the market. And that's not much, actually. That's why the market's rallied a bit this week, because although they've increased supply, it's a pretty minor amount. And, you've got to remember all of this is black oil, and we look at the market in terms of overall liquids. So when they say 137,000 incremental barrels of oil supply, which in itself is versus 105 million barrels a day of global liquids demand, it's not that big a deal. And in general, oil prices are set by demand. Now, of course, there's a big exception to that, which is that over the past 15 years, the US has put in an enormous shift in terms of increasing supply of liquids up to 20 million barrels a day from the US, which is just incredible. And as a result, we've been able to grow the oil market to 105 million barrels a day with what are very reasonable oil prices by historic standards. And if you inflation adjust them, they're actually low. People are just looking at nominal oil prices and looking at, a key level here in Brent, which is $65 a barrel. And we've held that level. But as you know, and I don't need to tell you that from Fire Island, there's a major slowdown that occurs now in demand globally, particularly in the US refining system. So the other thing we've got to watch out for carefully here is hurricanes and whether or not they'll impact US refining. And they tend to be a mixed effect, basically. They can be bearish, obviously, in terms of massive demand slowdowns you see in the actual reality of a hurricane. You get a boost of gasoline demand when everyone tries to flee the hurricane. You then get a big economic slowdown. And then if it's a bad enough hurricane, the market actually buys things like construction stocks because, of course, you've got to rebuild from the hurricane, and the market has no conscience. So it will buy construction stocks on, other things that are levered to hurricanes if they come. We are in hurricane season, and it's been fairly muted. Just the one so far that caused flooding in North Carolina, and that's the one that we've had. But we've got a couple more months really of risk here, and then we start to think about how cold winter will be. And in fact, we've had very cold weather up north in places, in some of the northern states around the Bakken and stuff, which it could imply, although it's too early to tell, that we get a cold winter this winter. Because the key problem that you've got here with cooling oil prices is twofold. The first is we came off a cold winter this past winter with a freezing February and a global cold winter, and that, of course, boosted oil demand considerably, maybe a couple of million barrels a day of incremental demand as a result of that. The second major, so the question becomes then, do we have a cold winter this year, or do we continue the trend of warmer winters that we've seen over the past 15 years or so? The other major problem, and of course you can't really call the weather, right? And so you're trying to work out what demand is going to be. Our target low, as I've told you many times, is February 2026. Well, we'll see how low oil will go over the next 12 months. And, who knows? But so far I would say it's been cool to chilly here in New York to end the summer. That's been very bad for natural gas and may portend to a cold winter. Who knows? And speaking of who knows, the second other major, really the defining driver for the next 12 months of oil prices is going to be the extent to which China builds inventory, because China building inventory has been a major factor in keeping oil prices up at where they are, above 65. 65 is an absolutely key level for Brent, and if we break that to the downside, fairly obviously, but it actually works out on the chart. The next level is 60, and then you're looking kind of at 50. So we'll see what happens with that. Now, on the Chinese inventory build, nobody knows. The data is extremely dodgy. The only way we can really know what's going on with Chinese inventory is from satellite tracking. And what they do typically is that oil storage tanks have floating roofs. And what the satellite trackers do is they check the shadows on the tanks. And then using physics, they've got a little pit bull there, and Athena's not holding back. Athena. So they look at the floating storage. They take satellite photos of the storage tanks with the floating roofs, and then they can infer using the physics that you learned in high school, I'm sure, to calculate the level of the tank, because you can tell by the diameter and height of the tank how much oil it would store. And what we know basically from the satellite trackers is that, and indeed the tanker trackers somewhat. Tanker trackers are also very important in this. We can tell that China has built a lot of inventory, over 1 million barrels a day at times, that has been really the difference maker in the oil market, apart from the weather this summer, which leaves us in the typical position where it's really tough to call oil prices because you're making a call on winter China inventory. What's China doing if they're converting to EVs and the only growth in their oil market is in aviation fuels, which will remain a massive theme for oil, by the way. The growth in aviation fuel demand is a huge theme, and we think the growth in sustainable aviation fuel is going to be huge as well. I remember a few years ago now, the CEO of Chevron here, I'm dropping some names here, the CEO of Chevron told me that the CEO of Boeing told him that every year 100 million people take a plane flight for the first time. And a lot of them are coming to Fire Island during the summer. Boom, boom. No, actually, you can only get here on a ferry. But so that demand side is very difficult to call, because China, it's a little bit somewhat strange that they're building inventory at all. But the theory is what they're doing is actually taking advantage of discounted Russian barrels in order to build inventory, which is typical Chinese trading. They have a very high reputation for trading commodity markets very astutely, and in a way that guys like me and others trading the market properly have no idea what's going to happen next. So welcome to covering oil. We have no idea what's going to happen next. But the things to watch are going to be Chinese inventory and imports. And of course, believe it or not, the weather. On the supply side, we know that the Saudis are pushing more oil back into the market. And that, of course, as we've told you many times, is bullish because we're working through spare capacity. So, the supply side and what Saudi are doing is kind of quite well liked by the market. And in fact, some of the top quality US exploration and production companies like it, because this overhang of spare capacity we've had in oil has been damaging as much for the equities, because the market can't capitalize what the true oil price is in order to value the equities, as it has been for the oil price itself. So that's a couple of things. Now, of course, I mentioned just then that China is buying oil cheap from Russia, and therefore building inventory while they can get the oil cheap. And of course, the next unknown is what's going to happen with Russia, and whether or not Russia is going to continue suffering a number of things. The first, of course, is sanctions. EU sanctions continue to get tougher and tougher, and they become more and more determined to stop Putin getting access to export revenues from energy. The second is, of course, the whole drama as regards what's happening with Russia-Ukraine. And therein is a huge issue for the oil market, which is the damage that Ukraine is successfully perpetrating against Russian oil infrastructure. You're hearing about Russian oil shortages in the domestic market, and that obviously implies that what Russia's doing is prioritizing exports for revenue in order to maintain their position, their military effort and everything else that's going horribly wrong in Russia at the expense of their own people, which is in line with what's been happening. So we'll see with that one. Iran is all quiet at the moment. The other wacky one that's happening is that you've got Venezuela with the US Navy massing there, and it seems to be an anti-drug move by the US Navy. But we'll just keep an eye on that one. And at the margin, incrementally, Venezuela is not making much difference to oil markets. And as far as I know, and I was with the CFO of Chevron the other day, Chevron is now exporting again from Venezuela. And so that oil keeps coming. There's a theory that the US administration has raised their oil price target somewhat, and so they're now fairly happy with oil prices. And I have to say that oil prices are just not a subject here off the, on the front page of USA Today is how I think about it. So, our gasoline prices on the front page of USA Today. They really haven't been for a couple of years now, and so it's just not a big political issue. It's seen as a general benefit, and of course, a general benefit that will be big today because we're getting the inflation number that everyone's very focused on. Because the way the market's trading right now is really a direction of travel towards U.S. Lower interest rates, and that would be, very impactful in a number of ways for almost all markets globally. Once the Fed starts cutting, which is, almost certain now as far as the market's concerned, going to occur this month. September 17th is the date for that announcement. So, we know the direction of travel, even though there's a lot of drama around the makeup of the Fed and, Lisa Cook and all sorts of other stories about what's actually going on with the makeup of the board of the U.S. Fed. But the bottom line is the direction of travel here is, despite the fact that economically you would say it could be very unwise to cut interest rates at this point, you can equally say it's absolutely necessary. Okay, we always like to do these things in one take, but unfortunately my dentist office called, so they interrupted. So here we go. And sure enough, as soon as I was dealing with that, news broke that the US, the Israelis, had launched a bombing raid on Qatar, which is pretty dramatic in terms of its geopolitical complexity, I would say. And there's a couple of simple reasons for that. The first is that the largest U.S. military base, certainly air base, in the Middle East is in Qatar. So you're now in a situation where the joint U.S. base, which is joint with the Qataris, is in the same location that the Israelis are bombing. But of course, this is a Hamas-directed attack, where the Hamas leadership is basically sheltered by Qatar. So, but that's complicated enough. And the second complication is that, of course, Qatar was and will be again the largest LNG producer in the world. In the interim, the US has taken over as the largest, and in fact, Australia had a little time when they were the largest LNG supplier. The US will regain top slot in a bit of a battle with Qatar. But obviously, if you've got Israel bombing Qatar, it makes people a little bit jumpy. But this was obviously a directed attack, and it was obviously with US approval because you've got the massive US airbase there, and there must have been some pretty hot calls going on as the Qataris were like, what are we going to do about this one? And the answer is probably not a lot. The impact on markets is relatively muted because I think it's seen to be a targeted strike. And, you're very unlikely to see, and it's also, the LNG is the LNG facility, Ras Laffan particularly, is quite distant relatively distant from where the bombing occurred. So that's that one that sort of interrupted stuff. Just quickly to completely change subject back to a couple of stocks that we talk about. One that we've liked a lot and has been working brilliantly has been CASY's, which is sort of a curious thing for us to cover, but it's the kind of thing we get to do now that we're independent research. And that's a gas station stock, so it's within our wheelhouse, but very few oil analysts cover it. It's covered typically by the retail people. And the reason for that is CASY's is actually the number 5 biggest pizza chain in the US. And that's why we like the stock. So it's a bit of an involved call, but they continue delivering and the stock's been a beast. If you look at it from the point of view of the 5th largest pizza chain in the US, it's extremely undervalued. As an oil stock, it's massively valued. We enjoy things that are undervalued, or at least getting multiple expansion as well as earnings expansion, which is what CASY's is delivering. Another smaller company that we like is Delek, and the small cap US refiners in general, who are doing very well from the small refiner exemptions that have been liberalized under Trump. But interestingly, of course, the original requirement to blend ethanol into gasoline came in under Bush in 2005. That was subsequently actually weirdly loosened as a requirement under Biden. And that was bad news for both farmers and for refiners. They managed to upset both sides. Under Trump, what you've done is you've put in a renewable volume obligation requirement to blend that's very high. And that's positive for farmers. But at the same time, you're granting small refinery exemptions to refineries with under 75,000 barrels a day of capacity, of which all 4 of Delek USA's refineries qualify. And that's the reason why those small cap refiners are ripping. They also are a good play on hurricanes, incidentally, because those inland refineries away from the Gulf Coast will benefit massively if a hurricane does come through and disrupt U.S. refining.
That'll do it. I think for the week, I'll just show you the beach here. This is the whole point, basically, of the Hamptons of Fire Island. This beach runs now a good 70 miles. I mean, obviously, this is an island, but pretty much all the way to Montauk at the end of Long Island. It looks as remarkable as this. The Atlantic is hostile. It's nearly killed me twice. Broke my front teeth, speaking of dentists, one year and nearly knocked me out, which I would have drowned from. And the second year, I dislocated my shoulder. My Australian nephews came and looked at the sea, and they're like, those are dumpers. And that means that, it's a very violent and dangerous sea, as I know to my own personal expense. And I actually stopped the boat. I retired from body surfing the second year. When I broke my teeth, I didn't retire. When I dislocated my arm, which gave me a twofer, actually. It's the most painful thing that can happen to a man, they say. The first is dislocating your arm, and the second is, I can't remember the second, so that's good. Oh, I broke my cruciate ligament. Yeah, that stung. I ruptured my cruciate ligament playing soccer in China, but that's a story for another day. All right, Alex, you got to have energy. I hope you're great, man. And thanks for watching. Have a great week.